Hello everyone. Okay, so the big event today obviously was the Bank of Canada policy announcement this morning, and they decided to keep rates unchanged at 0.25%. Now, there's a bit of shock to some people. Going into the policy announcement, financial markets were pricing in just under 75% odds of a hike, and a lot of people thought it was the right time for them to hike, given the backdrop and given the higher inflation numbers. Now, after reading through the statement and listening to the press conference at 11, uh, you get a little bit more insight into why they chose not to, and it's really not that surprising. So, one, they talked about inflationary pressures. Obviously, they're going to address it with higher rates. They've clearly now stated the path to interest rates policy will be higher going forward. So they've clearly laid out for everyone there. Some of inflation as well, they've noted, is due to the pandemic and supply chain disruption. So naturally, part of the inflationary story will drop off as we move past COVID at some point. Now, today, they chose not to raise, but they took other action to sort of still be somewhat hawkish, let's say. So one day, they obviously explicitly said they're going to be raising rates soon. They also decided to remove forward guidance, and also they talked about eventually quantitative tapering, right? So at some point, once they start to raise rates, what they said, they'll start to look at reducing their balance sheet and not reinvesting when bonds mature. They'll just let it roll off their balance sheet and start to reduce the amount of debt that they are holding currently. Now, going forward, obviously, the market's rate expectations have shifted now to the next meeting date, which is March the 2nd, just under 6 weeks. Right now, it's priced, last time I checked, it was about 97% probability of a hike. But of course, this is still data dependent. It depends what happens at that point. Now, one thing that Macklem, the governor of Bank of Canada, mentioned was Omicron was a factor they considered. Now, obviously, there's lockdowns right now, and there's other impacts to the economy. Canada's two largest economies, Ontario and Quebec, have both been locked down for some time. That's going to impact things, obviously. There's not a lot of travel right now. With the illness, obviously a lot of airlines have reduced their capacity, and there's other areas in the economy that are a bit slower because of lockdowns. Now, Ontario is set to start to move out of lockdowns next week, but it's a sort of phased approach. So there'll be some reopening next week, more, I think, in 3 weeks' time or so, and then a bit more in March. So it's going to be a lag effect because as things start to come back online, obviously it's not going to happen very quickly. So, depending on what happens over the next 5 weeks, will determine whether the bank goes or not. My personal view is that they wait till April 13th meeting because the March meeting is also not a MPR, meaning Monetary Policy Report. Typically, they like to go on those meetings. However, if, Omicron is kind of a non-event or the data shows that the economy is really, really doing well and everything's kind of firing on all cylinders, then they'll likely go in March. But it's very tough to say right now, but as we get closer to March, we'll have a better idea. So I read a Bank of Montreal report today as well that has their updated forecast, and they're calling for 3 hikes in a row, March, April, and June, which are the next 3 meetings. And for the bank to return to their pre-pandemic rate of 1.75% by April of next year. Now, this is pretty aggressive. However, they did mention that the last 4 tightening cycles all started with back-to-back hikes. So it does make sense maybe March and April or April and June as well, which will still be back-to-back hikes. So we'll see how that goes and obviously how this impacts the housing market because a lot of demand has been brought forward now for guys to try to get ahead of these rate hikes. So they're buying a lot right now or trying to buy. So there was an article, a very interesting article I posted on my Facebook and LinkedIn accounts this morning from Bloomberg Economics, which just kind of outlines or really looks at variable rate mortgages versus fixed rate mortgages and the large increase in variable rate mortgages that are being taken on by Canadians right now. Sort of historic proportions given how low it is and the spread to fixed rate mortgages. Now, the reason I thought this was interesting, because I've had this conversation with a few people about my views on fixed versus floating, which one I think makes more sense and reasons why. Now, the risk obviously is the amount of people that have taken on variable rate mortgages, right? If they're over leveraged, meaning they bought a house that they could barely afford and they're maxed out, okay? Now, as rates start to rise, and if they start to rise aggressively, that's going to increase their debt requirement. Now, a lot of lenders, or a lot of these mortgages can be structured such that your mortgage payment doesn't change. It's just the interest and principal component changes. So you pay more towards interest and less towards principal. However, again, now an affordability index or affordability factor sort of happens, because as people start to feel as though they have less money because interest rates are going up, maybe they decide to spend less on other areas of the economy, right? So it's going to be interesting to see how things develop for all these people who took on variable rate mortgages. If they have enough room or capacity to deal with the increased rates, or if you see a market impact such that over leveraged clients may be forced to sell higher priced properties and downsize, or obviously the investor base, which is huge right now. I think 1/5 of all new transactions are all investors, and in the article that I noted, about 40% of investors as of last year are just breaking even, right? So as investors, obviously they're more numbers based, and they care only about the profitability. So as these units become less profitable, maybe you'll see some of them divest as well. So there may be some impact, I think likely an impact on the housing market as interest rates rise. We'll just see what type of impact that is. So that's my take on today's data. We'll have the Fed coming up soon this afternoon, which is important as well. They're expected to hold as well, but to indicate that in March they'll be going, which is another reason why today for the Bank of Canada to hold is not too surprising, because typically the bank will follow the Fed and not lead. So given that expectations were for the Fed to be hiking in March, and that's been expected for the last few months, it didn't really make sense for the bank to hike today, especially with the uncertainty of Omicron. Again, markets like certainty, and having uncertainty of lockdowns and how this Omicron or any other variant may impact the economy, it didn't make sense for the bank to be hiking today. So we'll see what happens on the next run in March, I think March 2nd. As usual, happy to discuss with anyone, and if you guys have any further questions, let me know.